Good afternoon, Mr. Tucker. Thank you very much for coming to give evidence, and we are in fact responding to a specific request from you to do exactly that at the earliest opportunity. I note that in the pieces of paper that have come through to us this morning, that the Bank of England doesn't hold its own records or transcripts of any of these phone conversations. Why not?
I think many of these records, do come from the Bank of England, but we've pulled them together and checked that we had got a complete set.
Do you keep records of your phone conversations?
We certainly keep records of all phone conversations that have been where a note has been taken. The conversation with Bob Diamond was not a conversation that I made a note of or a private secretary made a note of. Sitting here, I greatly wish there were a note of it. The reason is these were completely extraordinary times where, for many of us, not only I, were rushing from meeting to meeting and making an enormous number of calls, taking an enormous number of calls, and it would be wrong to suggest otherwise than that the routine system of recording things was creaking.
So you did customarily record all your phone conversations?
In the normal course of business, we would make a note of material telephone conversations, yes.
Has there been any internal review of what went wrong here?
In terms of keeping a note of this conversation?
And the handling of this whole issue?
Not yet. It is something that I think we will come back to in due course when times are calmer again. We are still living through pretty well crisis conditions.
So there's been no internal review of the bank's handling of the LIBOR issue?
There has been. Oh, I thought you meant, sorry, of recording of notes. There hasn't been an examination of how we make notes of meetings and telephone calls, and I think that is very largely because of the pressure that the bank remains.
And what about the LIBOR issue?
And on the LIBOR issue, we've looked at that very carefully in the context of the 3 inquiries that have been conducted.
So there's been something done very recently?
There's been something done in the context of those 3 inquiries in terms of preparing.
And that's been completed, has it?
Well, in terms of the evidence that I gave voluntarily to the 3 inquiries.
I'm trying to get to the bottom of, since this all happened in 2008, I'm trying to get to the bottom in the spring of 2009, which is really the most acute time of this crisis, whether between then and now, as you know, this committee's been pushing for some thoroughgoing reviews of the bank's performance during the crisis, whether there has been, prior to the announcement of that work on those 3 reviews, any work done to examine the performance of the bank during the LIBOR crisis?
If I understand the question, no.
It sounds the way that you're replying to me sounds as if you're being economical with the truth.
No, not in the slightest.
Okay.
I was asked whether I would give evidence voluntarily to the 3 inquiries. I did that. We got together the relevant documents, and as I prepared for giving that evidence, but in that context, not more widely.
Can we turn to the Bob Diamond file note? Does that file note of 29th October 2008 accurately reflect the conversation with him that you had?
Not completely. Would it help to explain?
Why don't we do it in stages? Is there anything in there that's wrong?
I think what it doesn't capture.
Okay, but we'll come on to that. First of all, is there anything in there that's wrong?
I think the last sentence gives the wrong impression, yes.
And what should it have said accurately to reflect what you said to him?
It should have said something along the lines of, are you ensuring that you, the senior management of Barclays, are following the day-to-day operations of your money market desk, your treasury? Are you ensuring that they don't march you over the cliff inadvertently by giving signals that you need to pay up for funds?
Okay. Well, we're going to come back in somewhat more detail to some of that in a moment. Can I just clarify, was one of the senior figures referred to in there Sir Jeremy Haywood?
Yes.
Who were the other senior figures?
The person I spoke to most in Whitehall during this period was Tom Scholar at the Treasury. The other senior officials that I spoke to less frequently from time to time were John Cunliffe in the Cabinet Office and very occasionally Nick Macpherson at the Treasury.
Okay. And just back on the earlier point I was making a moment ago, you would categorically refute the suggestion that this conversation might reasonably have led someone to suppose you were inviting Barclays to join the pack and under-report libel?
Absolutely.
Okay. Pat McFadden.
Just staying on this and staying on the note, Mr. Tucker, the first line of the Bob Diamond note says, Mr. Tucker reiterated he had received calls from a number of senior figures within Whitehall to question why Barclays was always toward the top end of the LIBOR pricing. What was it these senior figures in Whitehall were worried about?
Well, I think it wasn't just senior figures in Whitehall. There was commentary in the market that since the beginning to the middle of October, when the then government, the authorities, had wheeled out a pretty powerful package of measures to stabilise the banking system, capital support, funding support through the credit guarantee scheme, and the bank itself extending and enlarging the special liquidity scheme, and also coordinated interest rate cuts across the industrialised world, that whereas some market participants felt that money market conditions could ease because funding was being provided by the official sector, Barclays had continued to pay higher rates in the market, and that as reflected in their LIBOR submissions. And there were two, I would say, two separate but related concerns, and by no means only from Whitehall, from within the bank, and I think from within the market. One was, is the package working? And why isn't it working? Why isn't it working here as quickly as it appears to be working in the United States? And the other element was a soft version, I would say, of is Barclays okay? Was the right decision taken when Barclays didn't take capital from the government? If you remember, Mr. McFadden, on the government's, the authorities' three-prong package was announced on the 8th of October, I believe. On the 13th, when it was announced that RBS and HBOS Lloyds were taking capital from the government, earlier that day, Barclays announced that they would not be taking capital from the government and would be taking various other measures. And there was a degree of concern about that. There was a degree of anxiety about that.
This is really important because there's been huge press speculation in the last week that these senior figures in Whitehall, and we'll come to who they were again, were worried to the degree that they were asking you to lean on Barclays regarding their LIBOR submission rates. I don't want to put words in your mouth, but I'm really keen to clarify this. Are you telling the committee that what these figures in Whitehall were worried about was whether or not the policy measures that had been put in place by the government were working, or were they worried about the Barclays submission rates and asking you to lean on them?
They were, you're not putting words in my mouth, they were worried about, there were two parts to this, which come together, I think. Is the package working? If it is, why isn't it working more quickly? Secondly, should we be worried about Barclays? And then I don't want to say that it was expressed as concretely as this, because I can't remember, to be honest, but there's a sense of, including in the bank, was the right decision taken in allowing Barclays not to take capital support from the government?
Okay. Now there's a long email from Jeremy Haywood to you, dated Sunday the 26th of October, which has been released earlier today. And without going through it all, it mainly concerns why Barclays and RBS are borrowing at what appears to be above LIBOR rates. It asks about the government's credit guarantee scheme and the fees involved, and it asks a number of policy questions about whether we've got this package right. Would you describe this email as typical of the kind of worries that senior figures in Whitehall had?
Yes. I think there are two parts to it, actually. The one part is the design of the credit guarantee scheme okay? And there was a debate that went on over a number of weeks, how to strike the right balance between not making it overly generous, because essentially assistance was being provided to the banking sector, and no one wants to make that too cheap, and it also needs to be okay with state aid. And then on the other hand, you don't want to make it so expensive that it doesn't do any good. So and then there are some technical questions about that, and in fact I think the scheme was changed slightly a couple of months or 6 weeks later. The other point, which is in the second or third paragraph, there's no incentive for lenders to offer funds after 10:30 at or below LIBOR when they know two banks will continue to pay above LIBOR throughout the remainder of the day. And that's a different concern, if you like, which is if Barclays, and I think the other bank was RBS, are paying up, well then people are going to want to lend to them, provided they do think they're sound, and that's going to dampen any easing in funding conditions and money market conditions. And remember what the authorities are trying to do at this point. I mean, this is absolutely dire what's going on. I mean, everybody now looks back to this period and says, oh, the package, it saved the world, which actually I do think it helped save the world. But at the time, there's anxiety about, is it working? My goodness, if people are going to, we can push as much money out through the credit guarantee scheme and the SLS as we like, but if people are going to continue to pay up in the money market funds, and I would observe that means real transactions, that's what's being referred to here, then the rate is less likely to fall and conditions are less likely to ease.
Can I ask you, did Jeremy Haywood or any other government official that you mentioned in your opening answer to the chairman ever encourage you to lean on Barclays or any other bank to lower their LIBOR submissions?
Absolutely not.
Did any government minister from the last government ever encourage you to lean on Barclays or any other bank to lower their LIBOR submissions?
Absolutely not.
Specifically, did Shriti Vadera ever ask you to lean on Barclays or any bank to lower the LIBOR submissions?
Absolutely not.
Did Ed Balls?
If I may just add one thing there. What's more, I don't think that I spoke to Shriti Vadera throughout this whole period at all.
Did Ed Balls ever ask you to lean on Barclays
No.
or any other bank?
No.
Or any other government minister?
No.
If I can take you back to the note, if no one lent on you, why does the Bob Diamond note of the phone calls say that you said it didn't always need to be the case that we, that is we Barclays, appeared as high as we have recently?
Because
what did you mean by that?
This isn't about LIBOR submissions. This is about their conduct, the conduct of their Treasury desk or money market desk, I don't know what they call it, in the money markets, apparently paying higher rates of interest, which I think you can see corroborated in degree in the note that Jeremy Haywood sent to me. And if you permit me to go back, one of the things that we had seen through this crisis is that money market desks, Treasury desks, can send up distress flares. In 2007, Northern Rock quite quickly was bidding the highest rate of interest to borrow at pretty well every maturity and pretty well every currency. I'm sure that isn't, I'm sure it wasn't every currency at every maturity, but lots of maturities and lots of currencies. And that brought forward its problems, because at the point of one of the great problems in markets in these conditions, and this lasted for 18 months plus, is that there are moments at which everybody knows what you look like and what they're thinking about you, other than the bank concerned. And we had this in degree during the autumn of 2007. During the autumn of 2007, I called the treasurer of a UK mortgage bank, not a LIBOR panel bank, and said, we're starting to hear chatter that you're bidding up, you're prepared to pay more for funds, you're offering more for funds in the market. Be careful, because it may bring about exactly the opposite of what you desire. And that was that kind of thing was in my mind when I spoke to Bob Diamond. And the whole point of speaking to someone senior is things are so fragile that be careful that, and I'm sure I didn't use precisely these words, that the bridge of your company is moving from the CEO desk, the head of the wholesale bank, to the money market, to the treasury desk.
So my final question is, if what you're telling us today is that this was a call which was one of concern at the rates at which Barclays were borrowing, because it might signal a weakness in the bank, what did you think when you saw almost every front page of every newspaper last Wednesday saying it was the Bank of England who told us Barclays to do this?
I thought I needed to come and ask to see your committee to talk about what's going on. I mean, during this period, the question is, Barclays was the next in line. The HSBC and Abbey National Santander was seen at that point to be safe, relatively safe in the context of the world falling apart. Two banks had been taken under the explicit wing of the government. That left Barclays. And during that period, the measure of credit risk indicated by the credit default swap market, Barclays was top. And the way this crisis unrolled in more or less every financial centre was, as one domino went, who might the next one be? Now, we were not in the position of thinking Barclays is doomed. Had we thought that, we, the bank, would have given very strong advice to the government that it wasn't safe for Barclays not to take capital from the government. But it was a hard call, and there was anxiety.
Thank you.
I just want to take you back to some answers you gave to questions I asked a moment ago. Just for the avoidance of doubt, can you confirm that there's been no internal process of review of any type of these events in the bank prior to the creation of these three inquiries?
There's preparation for the inquiries.
And so prior to the establishment of those inquiries, nothing whatever had been done? Nobody had come round to ask you any questions?
That's right.
Nothing whatsoever?
That's the preparation for the inquiries.
And just following up on a question from Pat McFadden, as to what you thought when you saw those headlines, you didn't cross your mind that Barclays were dumping on the Bank of England?
Last week's headlines were the week after the release of the conclusions of the three inquiries. The three inquiries concluded the US Department of Justice, there was no instruction was understood to have been given.
Okay. Michael Fallon.
Thank you, Mr. Chairman, and I again remind the committee of my registered interest as a non-executive director of Tulloch Prebon. If you had calls from number 10, number 11 and the Cabinet Office, it wouldn't be unfair to say, therefore, that the government generally was concerned about LIBOR pricing.
I didn't think that this was some ministerial thing going on in the background. The world is falling apart. Officials in prominent places have got a responsibility to ensure that they are, as best as they can, up to speed with what's going on, which, by the way, in these circumstances, it is an impossible task for anybody to know what is going on. I don't doubt they called other people maybe as well, but I was the markets director of the Bank of England. My job was to know what was going on as best as we could.
But did you assume that government was concerned about LIBOR pricing?
I assumed that they wanted to know about what was going on.
Right. Okay. In the first line of the second line of the Diamond memo, he reports that you had said that there were questions as to why Barclays was always towards the top end of LIBOR pricing. Does that not imply that you wanted to get it lower, or that officials or ministers wanted to get it lower?
No, I don't think it does at all, actually. I mean, I'm not here to defend Mr. Diamond's record.
So is this wrong?
No, you can go on to say you have to pay what you have to pay. In other words, you have to pay up in the market. The question is, perhaps I should back up a bit, because what is important from quite early in the crisis, from the summer of 2007 onwards, is that LIBOR became increasingly used as a summary statistic of what was going on in the market. And that is partly because, I think, for two things. First of all, LIBOR diverged from the safe rate of interest in a material way for the first time in living memory. And secondly, we became aware as the weeks and months passed that less money market activity was going via the brokers. More was being done bilaterally. And those are circumstances where actually everybody has less information about what's going on. And in those circumstances, you place greater weight on the indicator that is available every day, which was LIBOR. And I think everybody rather slipped into the habit of using LIBOR as a kind of portmanteau term for money market conditions, bank funding conditions, actual submissions, the actual LIBOR fix. And actually, I think that's going on to today.
Yeah, okay. But given that Mr. Diamond thinks he was being asked by you why Barclays were always towards the top end of the LIBOR pricing, was it unreasonable of Mr. Diamond and his lieutenants to interpret that as some kind of wish that somehow government would like to see his submissions lower?
Yeah, I think it was. As I understand it, he didn't interpret it that way.
But was it unreasonable of him to interpret it that way?
Well, it would absolutely. I mean, we wouldn't suggest anybody did anything wrong. I mean, there's a crisis going on. We're phoning up saying...
Yes, you've said that. But Mr. Tucker, we do have two rather odd things happening here. We have Mr. Diamond misinterpreting your phone call, which you made to him, and then we have Mr. Del Maizière immediately misinterpreting Mr. Diamond. So you do see there's a mystery here.
I don't think Mr.
How three very intelligent people, right at the edge of these markets, that there should be these two misunderstandings between the three of them, three of you.
I don't think Bob Diamond did misinterpret. His evidence, I understand, is that he did not understand an instruction to be given. I was plainly talking about their money market activity, and the reason for mentioning Whitehall was everybody's now talking about this. You know, the market must be talking to Whitehall about it.
Okay, well, let's just be clear once more. What did you actually... You rang him. What did you want him to do?
I wanted, as I've said already, I think, in part of my answer to Mr. McFadden, I wanted him to be sure that the senior management of Barclays was overseeing the day-to-day money market operations and treasury operations and funding operations of Barclays, so that Barclays money desk did not inadvertently send distress signals. You do not, in actual paying up for money, in terms of what you borrow, you do not need to be at the top of the market all of the time. It is very important not to come across as desperate. That is not a point about libel submissions, where people should just obey the rules.
But doesn't the danger of that call being misinterpreted, either by Mr. Diamond or its file note being misinterpreted later by Mr. Delmissier, doesn't the danger of that lie in the fact that you and other participants in the Money Markets Liaison Group were already aware, at least a year earlier, that there was suspicion on behalf of some of the participants that rates were not being reported accurately?
Well, first of all, it was not remotely in my mind during this conversation that I could be misinterpreted either by Bob Diamond or by anybody else. If you go back to the MMLG discussion, I think the prevailing view as it came across to me in the meeting in November 2007 was this market isn't working. It's sporadically illiquid and dysfunctional, which isn't the same as saying it's illiquid and dysfunctional all of the time. People are having to make judgments about where they would be able to borrow in the market. That is a much less secure basis on which to proceed with LIBOR, and that was one of the reasons why when we got to the spring we encouraged the BBA view and certain elements of the BBA review.
But don't you accept that it would be easier to brush aside these misunderstandings if you had not yourself already been aware a year earlier that some participants were registering concern that submissions were being falsified?
We were not aware of allegations of dishonesty. I was not aware of that. I think that what was being said we'd understood to mean these money markets are not working, they're dysfunctional, this is a much less sound foundation for determining LIBOR. It's a major piece of global infrastructure. That's not good, that's bad. And that increased, as it will probably come to, that increased in the spring of 2008, particularly around the dollar LIBOR fixing.
I think some of my colleagues may well be pursuing that.
David Ruffley.
Mr. Tucker, can I just direct you to the sentence in the first paragraph of the Diamond note dated 29 October, when he says, I asked if he, that is you, could relay the reality that not all banks were providing quotes at the levels that represented real transactions. His response, oh, that would be worse. I think we've already established that this text is a masterclass in ambiguity on Mr. Diamond's part, but could you perhaps just start by confirming that you use those words, oh, that would be worse?
I can't remember that I used those words, but
or words similar to it, because...
Well, this goes back to something I had said to Mr. McFadden, I think. So, banks are having to make judgments about where they could borrow in the market, if they're not actually borrowing in the market. If they weren't doing real transactions, then Bob Diamond was effectively saying, look, when they come to do real transactions, they're going to be paying the same as us. And that would have meant that the package actually wasn't having the effect that was desired.
No, I understand.
It would have been worse. It would have been pretty terrible, frankly.
Right, but he was quite clearly suggesting to you that in relation to LIBOR pricing, because the earlier part of the paragraph makes it clear he's talking about LIBOR submissions.
Yes, so then maybe.
Absolutely.
Yes.
We're agreeing
Yes.
on this.
Yes.
But he is saying, he's putting you on notice that not all banks were providing quotes at the levels that represented real transactions. Now, what my question to you is, what did you make of that when he said that to you in this conversation?
Well,
because this is rather important, isn't it? He was clearly telling you, according to his note of the conversation, that other banks, not Barclays, were providing quotes or LIBOR submissions at the levels that represented real transactions. That not all the banks were actually quoting at the levels that represented real transactions.
Well,
my question to you is, first of all, did he say that to you? And secondly, what was your response?
Well, certainly a bell didn't go off. My goodness, there's
No,
dishonesty here.
Did Mr. Diamond say that?
I understood him to say, we're basing ours on real transactions.
Yeah.
The other guys aren't doing that. Now, maybe that's because, this is now me, maybe that's because they don't have to borrow. HSBC, I don't think, had to borrow during that period, for example. In which case, the suggestion is, well, when they come to do real transactions, they'll find that they're paying a higher rate than they're judging they would need to pay. And that'd be worse, because that would mean that the package wasn't working.
I understand that, but just to finally nail this down, when he said that not all banks were providing quotes at the levels that represented real transactions, you didn't think there was anything untoward about that, and you didn't want to do anything about that.
A bell didn't go off in my head.
Right. Okay. Now,
I was focused entirely during this period on, is the package working? Is the world going to fall to pieces nevertheless?
Right.
Have things improved at all?
Now, Mr. Diamond, he says that he asked you to relay the reality that this was happening. To whom did you relay the reality, as Mr. Diamond would describe it?
I'm not sure. I mean, it would possibly in the following days in the conversations with colleagues and officials, but within I think less than 2 days, Barclays announced that they had raised equity from Qatar, and interest in Barclays more or less evaporated.
In his evidence to us, Mr. Diamond said it was clear that a number of the firms who were posting had emergency loans or had been nationalised or were having trouble funding, and yet we were posting the highest level. Then, as I said to Paul, we are funding at those levels, but we would question whether some of the other institutions can actually get funds at the levels they are posting. Now, this is what he said he told you. Were you at any stage responding to those alarm bells?
Well, if you think about those firms, 2 of them had taken not only liquidity assistance from us, but capital from the government. And so they'd become lower risk. I don't think I'd have been at all surprised in the shorter run that they were able to borrow more cheaply from Barclays, more cheaply than Barclays. I talked about Barclays being next in line. They were out of the line.
Exactly.
Indeed, to this day, I remain puzzled and concerned that as time moved on, the semi-nationalised banks ended up paying more in the market than other banks. But that was not the case at this point, and I wasn't surprised by that. And what's more, because we were lending them a lot of money, they didn't need to go into the market and borrow at all.
I think so
it's not surprising that if they didn't have real transactions.
No, I agree with that, and I think that's not. It's a logical explanation.
And of the other 2,
Absolutely.
HSBC and Abbey Santander, and at that point the spectre of the euro area's problems hadn't emerged. They were perceived at the time as, how shall I put it, rock solid by the standards of the moment.
Okay. Now on the 30th of October, this is after this disputed conversation. Mr. Diamond forwarded you a note by Andrew Jones, and it's in the bundle that the bank sent today. And it outlines a recent set of transactions under the government's guarantee scheme. Now, had you discussed this in your 29 October conversation?
I'd mailed him earlier than that, to say you've used the CGS scheme, you've paid 140 basis points over gilts. That's a lot. That's on the 25th of October. I can't remember whether we touched on it in the conversation on the 29th, but it was certainly part of the background to what I'm describing. Here's a bank that, even when it goes out and borrows with a government guarantee, is paying 140 basis points over gilts. That struck me as quite a lot.
Now, in that 30th of October email, I wonder if you could just tell us what you made of it, because it's the email from Bob Diamond to you, copied to Mr. Jones, and he says, Paul, I asked Andrew Jones to give you some perspective, quite a positive development, actually, that you and the government should feel pretty good about.
Well, I kind of took note. So they'd distributed it. It had gone to there are some redactions here to delete the names of people that had put in big orders. But I didn't feel wowed by if this scheme was going to mean that banks had to pay a 1.5% over gilts. And one might say, well, hold on, there's a liquidity issue here. But as I recall, these CGS pieces of paper were eligible in our operation, so they could be converted into liquidity quite easily. And even in the market, not every piece of paper needs to be super liquid. This had a government guarantee behind it. Actually, what I think it was a product of two things: just how incredibly traumatized the market was. So the market wasn't prepared to diverge very much at all from what it thought was safe, and maybe there was a kind of Barclays element in it there as well as the next in line.
Thank you.
Just come back to this sentence in the file note. Banks were providing quotes at levels that represented. Not all banks were providing quotes at the levels that represented real transactions, and you just told us that didn't set alarm bells going off. But this was usually the key indicator used to assess financial stability, wasn't it? Why didn't alarm bells go off?
Biggest markets had dried up, not completely, as I've already made clear, but the fact that, for months, there had been periods where sometimes it was based on judgments as to where they would be able to borrow, rather than actual transactions of where they were borrowing. And then things would loosen up again, and there would be some transactions. Well, it's.
So he was telling you something you already knew.
No, but it would be tremendously important if they were making the wrong judgments about where they would be able to borrow if they were conducting real transactions.
I've understood that. That's the point you made earlier. But I'm just on the point. Did you already know that not all the banks were
not on that particular moment? No, we weren't following.
But generally,
we knew that it could happen from time to time.
So
yes.
you did know that it was happening.
In general, that was the backdrop to the BBA review.
So why
earlier in the year?
Why was he so anxious to convey this reality to you?
I don't know.
You just
I don't know.
Despite the fact you were having all these frequent conversations, you seem to be at cross purposes on that
this
point as well.
This wasn't a call for me to get to the bottom of something, and it wasn't a call about analysing what's going on in the market.
Okay.
It wasn't. That was not the purpose of the call. Purpose of the call is people in the market are talking about you. They're talking to everybody about you, including people in Whitehall. There's concern about you. Just make sure that the day-to-day funding operations of your bank don't tip you over the cliff.
You've made that point, yeah. Andrew Ledson.
Thank you, Chairman. Mr Tucker, I find your evidence so far quite contradictory, and in particular I'd just like to draw your attention to the BIS March 08 report, where they say well-established benchmarks are critical to the efficient functioning of markets in these instruments. Benchmarks anchor the short end of the yield curve, thereby conveying information about expected future policy rates. Do you agree with that?
Well, the key measure of expected future policy rates throughout this whole period was the overnight index swap market based on SONIA, which is a measure of the average rate of interest on actual transactions in the cash unsecured overnight market.
So are you saying then that LIBOR was less important?
LIBOR as a measure of future policy expectations for the UK or the MPC for others, LIBOR was not that important. It wasn't what we follow to try and gauge expectations of the path of our policy rate.
So in effect, the interbank rate, because it wasn't working, had become less relevant to the Bank of England's understanding of the state of play of the markets, because that contradicts a lot of the evidence that we've heard so far.
No, it became a measure of something else. So the LIBOR, which is a measure of the rate of interest at which banks will be able to fund themselves, will reflect three components. The first component at any particular maturity is, well, what do you think the Bank of England's policy rate will be over that time horizon? The second is, and I'm talking about LIBOR as a whole now, what do funders think is the average credit risk and the compensation they should get for that credit risk in the LIBOR panel. And the third component would be, and whatever they think of the credit risk, does nobody want to lend because they want to hoard liquidity? And I think you can see this in our quarterly bulletin from to the middle of 2007 onwards. We looked at the wedge, the spread between LIBOR rates and this OIS rate, the measure of expectations of our policy, as a composite indicator of bank credit risk and liquidity risk. And then we looked at credit default swap spreads as an indicator of
Mr.
credit
Tucker,
risk and try to break it down.
Sorry,
sorry.
that's very interesting. Other colleagues might come onto that, but I'm
sorry.
very keen to talk about the bank's actual procedures.
Yes.
So you're saying on the one hand that LIBOR reflects the availability of cash, the presumed activity of the central bank, and the credit risk of the opposition,
Yes.
of the person you're lending to. So that surely then does make it absolutely a key anchor in the short-term yield curve, does it not? And in fact, the Governor himself said he thought that the LIBOR fixing should reflect the actual interbank borrowing rate as opposed to just some guess because the market isn't functioning. Would you agree with that? Is that a yes
as
or
you
a
just
no?
put it, yes.
You would?
But it isn't a measure of expectations of monetary policy. It is relevant credit conditions and indicator of liquidity conditions. And we
but
would
it should be actual rates.
And we would much, I'm sorry, we would much prefer it to be based on actual transactions.
But you don't require it to be based on actual transactions?
We don't require anything. We're not responsible for LIBOR in that sense. In the BBA review in 2008, apart from inputting some thoughts on governance and process, we made it clear to the BBA that we would not endorse LIBOR precisely because we wanted to keep open the possibility of moving to other measures, including a transaction-based measure, when things had calmed down.
Okay, well let's go back to your procedures then. Can you confirm that you are personally responsible for the effectiveness of LIBOR in the marketplace at the Bank of England? And you're saying the BBA is responsible for recording it, but at the Bank of England, are you the person who is responsible for that?
We didn't see ourselves as being responsible for its effectiveness whatsoever. We used it as an indicator of the things that I have described. We took we didn't take any responsibility for LIBOR.
For LIBOR in the sense of its accuracy?
We were not a regulatory body.
Okay, so do you have a procedures manual at the bank?
Yes.
And would you have a procedure for all contacts with banks in the marketplace? If you have a contact from a bank about a particular issue, is there a procedure that tells you how you should deal with that contact from that bank?
Well, people write up their calls as far as they can, as I've said already to the chairman.
So is it that on a best efforts basis, or is it actually a procedure?
During the crisis, yes.
So the procedure is there, but it's not always followed?
It could not be. It was impossible to do what you describe. There isn't a rule that people must write notes of everything. There is a policy that they must write. Sorry,
Mr. Tucker, is there a procedure that if you have contact with a bank in the marketplace as a Bank of England official that you write up a note about the call?
It's a policy that you should if it's interesting and material.
And that's what the procedure says?
That's what our policy says, yes.
And how often are the procedures reviewed?
Those procedures, that policy is ancient. Write notes for record of important conversations. That didn't happen during this period. There were too many conversations. There were too many things going on. The system was creaking.
So what's your whistleblower policy? If somebody from the interbank market calls you and says, I think someone's manipulating LIBOR, either with criminal intent or with intent to mark down their cost of funds, what's the procedure?
I haven't got
for
it in my
dealing with
mind
that?
now. We do have a whistleblower policy. We do review it periodically.
And so would you have followed the whistleblower policy in the case of Bob Diamond's call to you saying he thinks other banks are manipulating LIBOR?
I didn't understand Bob Diamond's conversation to be a whistleblower conversation at all. He didn't say to me, look, Paul, I'm trying to tell you something absolutely terrible here.
No, but he's telling you that the LIBOR submissions from other banks are not the rates at which they can borrow in the interbank market. And the rule around the submissions is that they should be the rate at which you borrow, not the rate you feel like submitting.
No, what he records himself as saying is that the submissions were not based on real transactions. That is different from what you have just said. And as I've said to the chairman, there were periods from the middle of 2007 onwards where the markets were so sufficiently illiquid and dysfunctional that there weren't real transactions, and then they would emerge again. And during this period, I think in response to Mr. Ruffley, I've given reasons why maybe some of the other sterling banks were not doing real transactions.
So is there in your...
I certainly did not. I did not understand this conversation in any way as Mr. Diamond telling me about dishonesty or cheating. I did not.
And so
I did, as I've said, thought, well, if he's saying that the market is here when they think it's there, and they're going to discover it's here when they go back into the market, well then, as I said to Mr. McFadden, the package is working even less than we were fearing.
So are you saying then that in the Bank of England's procedures there is a margin to allow for false submissions of LIBOR when the market is in crisis?
No, we do not have. We do not have a manual on the processes for LIBOR submissions. We are not part of the LIBOR panel. We do not oversee the BBA. We were not a regulatory authority.
So, but the Governor of the Bank of England has said that he thinks that LIBOR submissions should be transaction-based.
Yes.
And so what effort did the Bank of England make during that period to ensure that banks knew that the Bank of England believed that LIBOR submissions should reflect actual rates and not invented rates?
Well, if they could reflect actual rates, if there were no real transactions, they had to make judgments. I think the key period here is the BBA's review from the spring of 2008. And there is an annual review of some kind. We emphasised to the BBA that this review was tremendously important because of the eroding credibility of LIBOR, I phoned round senior members of banks and said this is not a review that should be conducted by the junior people that normally sit on the relevant BBA committee. It should be conducted by senior people in the banks. That's a message that I'm giving to all of the major sterling clearers. We encouraged the BBA to not just consult the banking industry, the interbank market, but also users of the market. And as the first round of the preliminary conclusions, the conclusions that were consulted upon by the BBA, were being drawn up, the BBA spoke to us about them, and we said, and they were setting up a new group to oversee LIBOR,
well,
and I said,
colleagues will come on to that.
And I said include asset managers and users of the market.
I think other colleagues will come on to that. Can I just finish up with two questions? Are you aware of LIBOR having been manipulated since 2008 by any bank submitters?
No.
So you're not aware of it, or it hasn't happened?
We're not aware of it, other than what is starting to come out of these investigations.
And so if LIBOR had been manipulated since 2008, would the Bank of England take any responsibility for failing to deal with its knowledge that LIBOR had been falsified, or would it see that as somebody else's responsibility?
We didn't have any knowledge. I didn't have any knowledge of this. I've said...
but you do now. Afternoon. I'm saying you did since 2008.
Well, we have since 2008, since the investigations.
Okay, so only since a month ago was the Bank of England aware that LIBOR had been falsified?
This was a cesspit, yes.
Okay, and final question. Are you concerned of any other fixings in the interbank markets that may have been manipulated, either for reasons of the financial crisis or for profit?
I think that as part of the review that the government has commissioned from Martin Wheatley, as well as looking at LIBOR, they should look at every single index that isn't based on real transactions, where participants in the market have to self-certify. That plainly does not work. Even if these other markets have been completely clean, and we have no information on that one way or the other, even if they have been completely clean over that period, as self-certification is plainly open to abuse, and so it could occur elsewhere. And yes.
Have you made that clear to Mr. Wheatley?
We haven't. Well, I think the governor made that fairly clear in the press conference last week. I don't think we've seen Mr. Wheatley since the review from him was commissioned.
Stuart Hayes.
Thank you. Mr. Tucker, can I take you back to the week after the telephone conversation with Mr. Diamond?
The week after,
yes. The 6th of November, there was a cut in the base rate of 1.5%. You'll recall that the banks did not immediately pass that rate cut on, particularly to people with mortgages. And that led to an emergency breakfast meeting on the 7th of November, where the Chancellor is reported to have read the Riot Act, furious that the banks hadn't passed the base rate cut on to consumers. They explained, and I'm sure you'll be familiar with this, that because the base rate was so low but LIBORs were still so high, it would have led to a reduction in margins and a loss both to the banks and potentially the taxpayer. And then on the 7th, lo and behold, the 3-month LIBOR fell by 1.07%. I understand it was the biggest single daily fall since 1992. How did that happen? Can you explain, given all the circumstances and the difficulties at the time, how the LIBOR rate fell to that extent that day and again the following day?
So haven't refreshed my memory of those particular days. What I would say is two things. First of all, it's many, many years, decades, since the Bank of England has tried to enforce the passing on of our bank rate cuts or rises. You set monetary policy, credit spreads and other things move around, you then have to take that into account. And I say that for this following reason, that during the course of back end of 2008, beginning of 2009, as we were taking bank rate down to near zero, part of what we were trying to do is offset the effects of tightening credit conditions. The steps that we took, the authorities took, that we thought could help to bring down LIBOR in the sense of, or the LIBOR spread between LIBOR and the risk-free rate, were the credit guarantee scheme and the extension of the special liquidity scheme and the capitalization of the banks. The first two mean banks should need to borrow less in the unsecured market, less demand pressure. The third, capitalization of the banks, government standing behind the banks, should have made them less risky, so that people, when they loaned to them, were less frightened and would charge less of a premium. I think those were the dominant. I actually believe that those were and have remained the dominant influences on bank funding costs.
Indeed, and those things were in place. They were all very important, but the LIBORs and the spread had barely moved. The question I'm asking is, we have this emergency meeting where the Chancellor reads the Riot Act, but there was no improvement in terms of those schemes. The banks had been kicking back against passing on the base rates, and then all of a sudden the LIBOR rate fell. That was against the backdrop of banks not being able to borrow, certainly not at the submitted rates, against the backdrop of an IMF report which was extremely gloomy indeed, also published on the 6th. Why did the LIBOR rates fall a near record amount on a single day?
I don't know. I haven't refreshed my memory of those days.
Well, let me ask you. You said earlier that there'd be no pressure put by the central bank on the banks to make lower than otherwise expected submissions. At the time when the government were desperate to see the base rate cut passed on, did the central bank make representations to the banks for them to make lower submissions to the LIBORs at that point?
I'm absolutely certain not.
That's helpful. Do you believe the banks themselves could collectively have determined that LIBOR submissions needed to be lower to shrink that spread in order to be able to pass on the base rate cut?
I have no evidence one way or the other. Such collusion would never have occurred to me until the episodes of the revelations of the last few weeks.
You've no evidence that they would have collectively come to that decision?
No. And if I could go back to the questions, I think, to Mr. Ruffley and Ms. Leadsom, these banks were in very different circumstances. You've got two in the state sector. I'm overstating the Lloyds HBOS bit. One, a massive Asian-oriented bank that is regarded as rock solid, if anything, is having safe haven flows to it. Abbey Santander still then in much the same position, and Barclays. This wasn't a homogenous group.
No,
Yes.
it's useful. I'm simply trying to get to the bottom of how this happened. Can I then take you to a few days later to the 11th of November? This is in the Telegraph. It's a short paragraph, so I'll read it all. Interest rate cuts. Banks being told to fall into line and lower the mortgage rates. Good stuff from the Treasury. After all, with the base rate falling and LIBOR following it, money should get cheaper for all of us. Shame Alistair Darling had to call all the banks into his office for a breakfast barracking to get it done. Were you aware that the Treasury at this breakfast barracking had instructed the LIBORs to be lower, the spread to be narrower in order for the base rate cuts to be passed on?
I have no recollection of that, or of anything like that.
Okay. Just slightly perplexed, and please forgive me, but we have a near record one-day fall in the 3-month rate.
Yeah.
The banks collectively couldn't have done this. The central bank didn't instruct. The Treasury didn't instruct. But there's lots of gossip and chatter and emails about how important the LIBOR rate is Indeed, you said yourself, LIBOR was used as a summary statistic
Yeah.
as to what was going on in the market.
Well, and then, as you probably know, the spread started to rise again back towards Christmas. The repair in financial markets was slow. A number of times during this period, I can't remember exactly when, I was asked by colleagues, why isn't all this repairing itself faster? Why aren't things having a quicker effect? And the answer I gave is, the market's traumatized. It's as though everybody's been in a motorway pile-up and they've just escaped and they've pulled over to the hard shoulder and they're kind of holding their head in their hands, and this will take time. And it kind of did.
So Mr. Tucker, the argument there would appear to be that a record one-day fall after a breakfast barracking with the Chancellor at a time when the banking establishment quite rightly wanted LIBORs to be lower was the consequence of a traumatised market and nothing else.
I see the question. I haven't refreshed my memory of this period.
I would be grateful if you could look at the period of the 6th to the 11th of November from the base rate cut and its aftermath in relation to what may or may not have been said about LIBOR, because I think it's extremely important indeed.
Thank you.
Teresa Pierce.
Thank you. Mr. Tucker, the note that Bob Diamond wrote, when was the first you saw that?
I can't remember exactly. As part of the process around the three inquiries of Department of Justice, FSA, CFTC, and Department of Justice.
Did you at the time go back to Mr. Diamond and dispute any of the notes?
No.
Okay.
No. I have never spoken to Mr. Diamond about this note.
Mr. Diamond, as you know, was before us last week, and in his evidence he said about you that he was trying to tell me there were a number of ministers in Whitehall who were worried that we were not able to fund. And it seemed to me that he was saying that you were trying to give him a nod and a wink. He also said to us that he took from the conversation that you were saying, my goodness, Barclays can't fund, we might need to nationalise them. Was that your intention?
So I certainly didn't mention ministers, and I know that I didn't because I wouldn't.
But was it your?
It was.
Were you meaning to convey the possible threat of nationalisation?
No, I wasn't. I think I did mean to convey, as I've said, you're now being talked about everywhere. There's anxiety about this. There's anxiety about whether you're okay, whether you're going to have to pay up.
So he seemed.
Well, they had. If you'll forgive me, so this is me trying to make sense of it rather than recollecting. Well, the first bit I absolutely recollect. Barclays had been very clear that they did not want to take capital from the government, and that they did not need to take capital from the government. And they put out an announcement on, as I said early on, I think the 13th day that the RBS and HBOS nationalisations were announced, listing actually quite a series of actions that they were going to take. And so the next bit is, and I also said, and this is also recollection, clear recollection, that there was nervousness in the bank, and I think amongst officials about how firmly based is that decision? Have we done the right thing? And then the bit that where I'm trying to make sense of it and is not recollection. In those circumstances, my phoning up and saying everyone's pretty worried about you because everyone's talking about you and the rates that you're having to pay in the market. Not for me to say, but I suppose that could have played into their concerns about escaping nationalisation.
Okay.
But the first two bits are clear recollections.
Okay, thank you. In the press last week, it was reported that Mr. Diamond had partly resigned because of an unambiguous message from the bank. Did the Bank of England convey that message to the board?
I think this is something that you ought to raise with the governor when we come back next week, rather than I was not personally involved in these in the discussions.
But you were aware there were discussions taking place.
I was aware. I wasn't deeply aware. I was aware of there was great concern amongst all of us. You could see it at the press conference for the financial stability report last Friday or the Friday before. That there was great concern that trust has to be re-established in banking. This is now different from and extra to the whole safety and soundness, systemic stability, resilience. Massively important though that is. This is now, can we actually trust the honesty of core wholesale markets? That has to be addressed fast. I would have wanted, if I can put it like this, I would have wanted the regulators and the bank to make clear to the Barclays board that they needed, as the institution that was in the spotlight and found responsible for terrible practice, that they needed to take decisive action to start the process of cleaning this up.
So are you saying that's a question we should make to the governor and not to you? Did the governor take soundings from the court, including you?
We talked about our response to, not about the particular thing, but about the more general response. Yes, we talked about it in preparing for the financial stability report press conference.
Do you think that Mr. Diamond did the right thing in resigning?
I think the events of the past 2 weeks or however long it is show that absolutely decisive action was needed to start a new chapter.
Does that reflect a long-standing concern?
No. What has been revealed has come as a deep shock. A deep shock.
Despite the fact that a review into LIBOR has been going on for some time.
Oh well, we didn't know. We didn't know what it would find. I mean, you're right to pick me up on that, because there are two periods. There's the period before I knew that any inquiries were going on before. Relative to that, an absolutely massive shock. Since we knew about the inquiries, we knew that there were suspicions, but we didn't know what the inquiries were going to show. And we still don't know what. I mean, there are inquiries still underway, and we don't know what they're going to show.
Andy Love.
Mr. Tucker, can I go back to that conversation and the note that Mr. Diamond gave? You've told us today that your primary memory of this is that you were clearly concerned about whether the package was working or not. You were concerned about Barclays' ability to finance itself at this particular point in time. But the onus on Mr. Diamond, and certainly in the evidence he gave last week, he stressed the continuing discussions about LIBOR rates. Can you just confirm how much the discussion was on LIBOR, whether he's correct that it was a major part, or whether it was really a subsidiary issue?
Well, no, LIBOR is used as a summary statistic. If I go back to one of my earlier answers, in conditions where less activity was going through the brokers, more is being done bilaterally between borrowers and lenders, and there is just less activity. We were more reliant on LIBOR as an indicator of what was going on, and we used it as an indicator of what was going on. And we thought that it was a reasonable indicator of what was going on. Actually, it went up. It went up a lot after Northern Rock. Again, it then came down a bit. Went up a lot at the end of 2007. Came down a bit during the spring of 2008 when things deteriorated here. It started to drift up again and was considerably above the price of borrowing in dollars or euros, and then after Lehman it absolutely shot up. What's more, the dispersion of submissions widened and the ranking of them seemed broadly to make sense relative to perceptions of credit risk. We didn't do scientific tests of that. I'm being long-winded and I apologise, but we were using it when there wasn't much more concrete information about. I think we all used it and referred to it as a summary, as a reasonably reliable summary statistic, and I don't doubt that I did that when I talked to Bob Diamond.
But your recollection is you did that in the context of Barclays' difficulties in funding itself.
Potential difficulties.
Yes. Rather than his submission to us, which was that there's a lot of banks out there doing this and we want to highlight this to you. We're the honest brokers.
Yeah, well, you know, everybody was saying, well, I don't want to overstate it, people were saying different banks were getting LIBOR wrong. But these were judgments about what they could borrow at in the market.
Mr. Diamond said that this was just one of a number of conversations he had with you specifically on the LIBOR issue. Do you remember any previous conversations with him or with senior officials that would report to him at Barclays?
No, I mean, they had said, without labouring the point, we're calling it where we see it, which is what all of the other banks said as well. They never at any point said, actually, Paul, we're trying to make a different point to you here. We're going to make a point about dishonesty. You're not hearing this. At no point was there anything like that.
So when in your recollection, when was the first time that LIBOR was raised as an issue in relation to lowballing?
To
lowballing.
I wasn't aware of allegations of lowballing until the last few weeks. I've referred a couple of times to the events leading to the BBA review and what happened with dollar LIBOR. People became concerned in the United States about what, in the spring of 2008, about where dollar LIBOR was relative to where dollars could be borrowed in New York. And this did concern people, and we heard about it, there was chatter about it. The New York Fed raised it with us, and that was the background, or part of the background, to our emphasis on why the BBA review of LIBOR governance and processes in the spring onwards of 2008 was so important. But can I say two things about this, please? First of all, we use LIBOR as the basis for the fees in the special liquidity scheme in, I think, April 2008. This was our biggest intervention in the crisis in terms of providing liquidity and trying to ease funding conditions. We would not have dreamt of actually using LIBOR as part of the pricing structure for Bank of England operations had we had doubts about what is now referred to as lowballing or highballing or anything else. We thought the underlying markets were dysfunctional, sporadically illiquid, much less reliable than normal, but we didn't have suspicions of dishonesty, and we actually thought, as I said just now, we thought the pattern of LIBOR movements made sense.
You will know from the FSA and other reports that lowballing was going on, pardon me, for some considerable period of time before the events that we focused on.
We did not
almost a year.
We did not realise.
I wanted to ask you, you mentioned earlier on that during this period of intense activity, you hadn't been able to record any of the conversations. Would that apply to all the period back to when the lowballing started in October or so, 2007? And would there be any recordings of conversations that may or may not have been held with Barclays or other banks in relation to LIBOR?
In terms of just not doing as many notes to file of conversations, I should think that starts back in the middle of 2007 when things start to get out of control. I mean, we need to review what there is. But
sorry, so just to be clear,
yes.
This note-taking was okay until Northern Rock, basically, is what you're saying.
Yeah, I think.
And then once Northern Rock came along, the whole system of note-taking collapsed.
And well, it is not a binary thing, because the degrees of pressure went up and down.
So we'll find the odd notes here and there.
Yes.
It does sound a bit of a mess.
It was a mess, Mr. Chairman. It was, the world financial system was progressively falling apart, and then did fall apart. And we had experienced nothing like it.
But this was at a critical time where judgments were being made and conversations being held.
Yes.
And it would have been...
Yes.
If
So
only
during this period, the biggest thing for us in the sterling markets was the preparation of the special liquidity scheme, which took about 6 weeks, and partly it had been prompted by rumours of HBOS being in trouble, which I think were false, and there was a rise in money market rates in sterling relative to dollars and euros, which suggested that the pressures were accumulating on UK banks. And the SLS was wheeled out and planned and designed to try and underpin funding conditions in UK banks. And we were spending an enormous amount of time on that.
Can I just add, in an earlier reply to Mrs. Leadsom, you indicated that the bank does not have any specific responsibilities relating to LIBOR, but you do accept, and you have in your answer to my questions, accepted that it's a critically important benchmark. Indeed, you've used it yourself. Does that not give the bank at the centre of economic activity in the city a special responsibility to safeguard LIBOR from any attempts to manipulate it?
Well, we didn't see it like that. The job of overseeing manipulation and
I'm not suggesting
another authority.
I'm not suggesting you
going,
should have overseen manipulation, but when
yes.
people are saying to you that there is Mr. Diamond claims that he said this to you, there are reports out there that this was said by other banks.
We were worried about the credibility of LIBOR as a piece of global financial infrastructure, increasingly through the spring of 2008. And as I've described, we underlined to the BBA how seriously they had to conduct their review. We underlined to the banks that they had to participate at a more senior level. We suggested to the BBA that they had to go beyond the banking community and reach out to the users of this index. And we made it clear that we would not endorse LIBOR because we wanted to leave the door open to further reforms. We, in the circumstances of the time, with things falling to pieces and the sheer scale of and difficulty of transitioning.
Well, I've now been looked at by the chairman.
Sorry.
Let me just ask you one final question. Do you think that response to the BBA, with all the concerns that were being expressed, was adequate? Should the bank not have stated more clearly their concern, not about the accusations of manipulation, but by concerns that the BBA form of LIBOR wasn't adequate to the task necessary in a modern economy?
I think that our response and input to the BBA review was very serious, and it was adequate. We made a judgment, if you like, that moving away from the existing method of collating LIBOR based on judgment, self-certification, away to a transactions-based measure was just not feasible during a financial crisis.
Okay, Mark Garnier.
Thank you, Mr. Chairman. Mr. Tucker, I just want to be absolutely clear about one thing you said in response to a couple of earlier questions. And that is, I think you said that prior to the end of sort of the latter part of 2008, you weren't aware of any LIBOR lowballing. That's absolutely your position. For the record, you're nodding.
Yes.
Okay. Can I refer you to the Bank of England Sterling Money Markets Liaison Group in the meeting of the 15th of November 2007?
Yes.
Where the minutes note, and this was a meeting that you were at, along with Simon Chatterton, who was an alternate from Barclays, and John Ewan, who was an alternate from the BBA. The minutes note that several group members thought that LIBOR fixings had been lower than actual traded interbank rates through the period of stress. That was in 15th of November 2007.
Yes, and well, first of all, if I may say two things. I was chairing this meeting. I can remember that part of the discussion in broad terms, and I can remember turning to the BBA and saying, please address these questions as the body responsible for LIBOR. During this period, if I may address the point more directly, as I've already said, less was going through the brokers, more was being done bilaterally. People didn't know very much about each other's transactions at all. And so I heard this as they don't know what each other are doing, that it was a questioning the judgments that they were that the different parties were making, or that they were relying on bilateral private transactions. I didn't read this as cheating. And when John Ewan responded, there wasn't then a great outcry in the room, and people didn't get in touch afterwards and say, you've missed the point here.
But you would understand why people would think that you have absolutely missed the point, because of course and I've come back to my first point, which is that you just said to us quite clearly that there was no suspicion that there was lowballing, and yet this is a minuted meeting a year beforehand.
Yeah, and went on our website and with lots of people.
Sure, I'm not suggesting it's just very, very.
No. I mean, it was the reason I say it went on our website. This was fully transparent to the world. No one was phoning up afterwards or saying you've missed the point, you haven't got this, or we've now seen this on your website. This is signalling something dishonest. This was a dysfunctional market.
But it's clearly lowballing. This is clearly stated.
I think it may well be in hindsight, but that is not how we understood it at the time. And if I may,
it's another misunderstanding.
If you go on to the April MMLG, some group members thought that fixing LIBOR rates was complicated by a lack of term liquidity. Yes, it was.
I mean, I completely appreciate that the markets are as illiquid as anything, and it's incredibly difficult.
Yes.
I mean, you then go on to have a sort of discussion with the BBA. The BBA official replied to the concerns about LIBOR, which is clearly a responsible thing. The dispersion between the panel bank submissions had increased in August. And I find this an extraordinary thing to say, but has since fallen back, in part reflecting clarification from the BBA on LIBOR definitions. I mean, that almost suggests that the people who are submitting LIBOR rates didn't actually understand what it was they were doing.
Well, I don't
For the
know
record,
about,
you're nodding again.
I don't know. Well, I don't know about that. I understood this as this market isn't working. There are in dysfunctional, sporadically illiquid markets, banks have concerns about where they're putting their libel submissions, but nobody presented this as dishonest. Nobody.
I'm not suggesting they are doing it as dishonest,
Yes.
but clearly, as I read this, then it is a if you like, a distress flow or a big red alert signal coming up that there is something absolutely fundamentally wrong with this market. The libel rates are not reflecting the true interbank lending rates of the actual trades. And that the BBA have actually admitted in, I mean, obviously minutes are precede versions of the conversation, I understand that, but on reading this, it suggests that the BBA are admitting that the contributor banks don't understand how to fix a line.
I mean, on the first part of that, this was an alert. I don't think anybody needed an alert that this was a market in.
It was an alert to
that was
lowballing.
dysfunctional.
It was an alert.
Well,
to
I think with hindsight it looks like that. We didn't hear it like that. I think it was not unreasonable to understand it in a different way. I really do.
I'm going to press you on this quite hard, if I may, because clearly people are very, very worried about this. And to come back and say that you didn't necessarily understand a very, I mean, we can all look at these with the benefit of hindsight. And I completely accept that given what subsequently went on, there was more information to understand what was going on. But this, to me, would strike me, those two statements, that libel fixing had been lower than actually traded interbank rates through the period of stress, coupled to the second part, which is in part reflects clarification for the BBA on the libel definition, implying lack of understanding. Those two statements together imply to me that there's a fundamental problem with not just the liquidity of the market, but the understanding of how libel works by the contributor banks, coupled with the fact that they are consistently lowballing these rates for whatever reason. Now, subsequently, it has been alleged and it's been discovered that it's possible that lowballing was in order to create a false impression about the liquidity of the bank in the case. But nonetheless, at this point,
well,
as
yes.
the Bank of England, and irrespective of whether you're the regulators or not, surely you must have been extremely worried about the fact that these libel rates were being lowballed.
Well, on the first part, lower than actual traded interbank rates, as I've said a few times, more activity was being done bilaterally rather than via the brokers. The banks knew very little about what each other were able to borrow at. This wasn't something that they could look up on a screen anymore or get gossip from the brokers. Each bank knew itself where it was able to borrow or potentially able to borrow. On the definitions, I didn't understand that as that there's a bunch of crooks who've been willfully departing from the definitions. I understood that as, my goodness, people have had to be taken to the text again and reminded what to do.
Did you feel that that would have been the right time to have a quiet word, officially or unofficially, with the FSA to see if there's anything?
Well, the FSA were there.
Yeah. I mean, did you have a conversation with them privately afterwards?
Not that I recall, but the FSA were there. And in fact, the markets part of the FSA was there. I would have had a conversation had I suspected foul play. I didn't.
Was this the first point at which you had ever seen any evidence of lowballing?
I didn't see any evidence of lowballing at the time. I didn't.
You will see why I find that.
I understand why you're putting the question to me, but I didn't.
The minutes actually do talk about low. I mean, they don't use the word lowballing.
They do not talk about lowballing.
Several group members say that libel fixing
lower than
had been lower
actual
than
traded
actual traded
interbank rates. What traded interbank rates I think of as brokered rates in this market rather than bilateral transactions. I'm thinking at this point, people don't know what's going on. This market is dysfunctional, sporadically illiquid. A lot of it has disappeared from, some chunk of it has disappeared from view. It did not set alarm bells ringing.
So at that point, you thought this was a genuine misunderstanding of what was going on in the market?
We were that there was great uncertainty about where people thought they could borrow in the market, and there was what became, after Christmas, as we went into the spring, a creeping problem of the credibility of LIBOR, and that, as I said, that led to the inputs we gave to the BBA review.
I mean, one of the points is that the BBA officials were responding to concerns about dispersion between panel banks. Now, clearly, dispersion it would indicate lack of understanding, but lowballing, when if you have your averages is now underneath where these actual lending rates are, as opposed to grouping around it, then that would indicate some sort of slightly different activity.
I don't know. I think
as a risk-based, if you're looking for risks in the system, if you see a random plot of LIBOR rates around where it actually is, then that would, to my mind, signify that you've got people who don't understand what's going on. If you see those plots of LIBOR rates gravitating towards one side or the other of the actual interbank rates, that would tend to suggest to me that something different was going on that needed investigation.
Well, they can't all gravitate to one side or the other because it's an average.
Correct.
And it's a trimmed.
That's right, and yet they were
average.
they were gravitating to below the interbank, the actual rates.
Well, not where the LIBOR rate itself.
But it doesn't say
average
in the minutes.
No, it says that some people say that actual traded interbank rates. I think that during this period, where you get your rate at 11 o'clock, you might find at 11:30 or 12 o'clock or 1 o'clock that you could borrow at a different rate, higher or lower.
For sure.
We were very, very bothered during this period about conditions in the money markets. This was a period quite shortly after this, I think, in which we introduced operations to try and tide the money market over the Christmas New Year period, because we thought there could be a crunch at that period. We're focused on is this going to take another lurch down in terms of credit tightness, and I'm afraid we're regarding LIBOR as one of the few indicators we've got of what's going on, and dishonesty did not occur to us.
Dishonesty, but nonetheless, this is my last
Well,
point.
lowballing would be dishonest.
Okay.
Mr. Tucker, you were chairman of this meeting, and you're responsible for the minutes. And you're telling us now that the minutes are misleading.
No, I don't think I am.
Well, it says here, several group members thought that LIBOR fixings had been lower than actual traded interbank rates through the period of stress.
Yes.
That reads as unambiguously lowballing. It reads as unambiguously people submitting returns below what in fact were the traded rates.
Or that they are doing private transactions that people can't see, because it's not in the traded market. The money markets had fundamentally changed. Which
no
is why
alarm bells at all rang when this was said to you?
No.
These group members presumably are banks.
Well, they're you can see them at the front. They're not all banks. There are some users as well.
Okay, so from recollection, without disclosing who, which you may not want to do, can you tell us what class of institution were these group members?
I can't remember in detail.
Although you can remember what happened immediately
I
afterwards,
imagine,
which was that you turned to the BBA.
Yes.
You can remember what you did afterwards, but you can't remember who.
Well, there was. Well, you asked me.
This.
There were quite. It says several, so quite a few people commented. I can't remember exactly who they were.
This doesn't look good, Mr. Tucker. I have to tell you, it doesn't look good that we have in the minutes on the 15th of November 2007 what appears to any reasonable person to be a clear indication of lowballing, about which nothing was done.
Well, we thought it was a malfunctioning market, not a dishonest market.
Okay. John Mann.
Because there's another word for it, and that's criminal fraud. That's what that minute refers to. You used an interesting turn of phrase, we. In each case, you use the we rather than I. So you must have discussed that issue with colleagues afterwards.
there's a team in markets we talk to about everything. Yeah.
So you discussed that matter with colleagues afterwards.
Well, don't want to suggest that we sat round and said, well, what do you think about that in particular?
Well, what one would have thought you would have done. It's important enough to minute, and it's proven to be a criminal fraud.
And which we did not realise at all.
Now, at the same time, academics realised it. Spence had been warning about this for some years, but precisely at the same time, Christian Erhard of Switzerland identified this. Rosa Abrantes Metz specifically identified these issues soon afterwards. So outside academics could see what was going on and identified it, and indeed suggested some solutions. Why could they see it from the outside?
Well,
and you're warned on the inside, but you don't see it.
Well, we didn't see it. I think there were other studies, including one by the BIS, although I think I'm aware of this after the fact, that didn't conclude that it was a problem. Maybe we were just too focused on the financial crisis.
But here you've got an enormous and highly reputed research backup with lots of staff at the Bank of England. You have academics writing papers alleging market manipulation that equals fraud, unambiguously, but you don't notice it.
We were throughout this period, and this particular period, focused on then how to get through December and the end of the year and into January without things taking a
and it's
turn for the worse.
specifically mentioned in your own committee.
And we were also very worried that further mortgage banks might fail and run out of money. I mean, this was a period. It was innovated. I mean,
we're very aware of the period in time, but we're also aware now of the academic research that's been going on for some time. But clearly, you and others in the bank weren't, and that is also worrying. Can I ask separately? We had Mr. Diamond here on Wednesday. You were asked to release these emails in advance, and you're accountable, the bank, to this committee under statutes.
Yes.
Why didn't you release these handful of emails?
We were asked under an FOI request from you personally. We went through our FOI procedures. We wanted to ensure that we had covered absolutely everything. Rather than giving you an adequate response, you have got it as soon as we could.
It's self-evidently obvious that these emails would have been useful to us in questioning Mr. Diamond. Extremely useful, but you didn't provide them. Under what authority were you acting in not providing them when you were specifically requested them in advance of the meeting with Mr. Diamond for the meeting with Mr. Diamond?
We were sent an FOI request by you, Mr. Mann.
Followed up by phone calls.
And we absolutely, the team processed it in a speeded up version of what they would normally do for FOI.
But this is the Treasury Committee questioning Mr. Diamond on major issues, of which the headlines put out by somebody incorporate various matters that have been already discussed with you earlier today. And yet, these emails, which would take a few minutes to put together, are not provided when requested to this committee. With what authority is the Bank of England operating on by refusing this committee those emails when you have a precise request?
I don't. We had an FOI request from you, Mr. Mann. I don't think we did have a request through the chair or the secretary of the committee, but we processed this FOI request as quickly as we could. We've done it faster than I think the permitted timetable, and we've got it to you as quickly as possible.
FOI is one piece of law. The accountability of the Bank of England is a separate piece of law. I mean, you haven't given us yet. I understand these emails refer to a chain of events going back to a supper between you and Mr Hayward, which I believe took place on the 6th of July. Why don't we have the emails between the 6th of July and September?
6th of July. There was a supper with Mr Hayward just before the email change. That's in October. I haven't checked the records of earlier suppers.
Well, the email chain begins the 6th of July. So why don't we have, they may be innocuous, but why don't we have the emails from the 6th of July?
I see. Well, I assumed that, and I'm pretty sure of this, that Jeremy used the mail saying thanks for supper as a way of finding my mail address. He just did a kind of search Tucker and then sent. There are not missing mails between Mr. Hayward and me, Mr. Mann. We have provided you with a full answer to your FOI request.
Is the Royal Bank of Scotland equally culpable in your judgment now as Barclays is in regard to rate fixing?
I cannot possibly know. This is why inquiries, investigations are continuing by the relevant authorities. I have no idea.
And other banks other than the Royal Bank of Scotland?
Well, I mean, I've seen in the newspapers over the last year or so the same list of banks as you. I do not know.
But that's because, not least, there's been court papers filed in the United States against these banks. Some people sacked, some of those people sat named in these court papers. So they're publicly available. You're saying that the bank's not taking a keen interest in this?
No, not at all. I mean, these are investigations being conducted by the relevant authorities, the FSA, the CFTC, and the Department of Justice. It's not for the bank to intervene in that. That process has to travel its course.
Did the Chancellor of the Exchequer, before his speech in Parliament on Thursday and his article in The Spectator, contact you, or did his officials contact you or your officials in relation to the accuracy of the issues that he outlined in The Spectator or in his speech in Parliament?
Well, I've read neither. No, I think they were aware, of course, of the Department of Justice, CFTC, FSA conclusions because they were published the previous week.
The market manipulation that has been going on, you kind of answered the question previously, but what else should politicians be looking for in relation to market manipulation other than LIBOR that may have been going on from your judgment now?
I think looking at these other self-certified indices, I've got no evidence whatsoever that they were problematic, but I think their design should be changed, even if they're squeaky clean. I also think that in terms of the changes that need to be made in banking to restore trust and credibility, I think we've got to get to a point where Treasury departments are not profit centres, where they are there to fund the bank or the dealer. They are there to ensure that the bank or dealer has adequate liquidity on a rainy day, but they're not actually a profit centre being rewarded on profits. I think this is tremendously important. If I may say, I don't think bankers should wait for findings from regulators or this committee or authorities internationally to do that. I think they should just get on and do it.
Are there any other processes in your view that should be banned?
Should be banned?
Yes. Or more tightly regulated?
Well, I think extending the scope of criminal sanctions is really important. I think that something else that needs to be looked at is incentives. There's been an awful lot of discussion and some measures taken internationally and domestically about pay of the top people. These remuneration codes, the FSA, the EU, the Financial Stability Board for the G20 and beyond. But actually I think that there is probably an issue of the structure of pay for more junior people on the desks as well. It has probably been too easy to get rich quick, and I think I haven't thought this through carefully, but it's hard not to ask yourself the question after the revelations of the past fortnight, should remuneration at desk level bear some resemblance factor in compliance breaches, enforcement actions within that unit, within the division, and beyond. I also think that we need, as the Governor has said, that the kind of vicar split of commercial banking and wholesale banking needs to proceed.
This is very big general.
Yes,
Yeah,
I'm sorry.
Final question. Yes, my final question on sanctions.
Yes.
What range of sanctions should there be on those in a position to see market manipulation, but who fail to see the evidence in front of their eyes?
I'm not an expert in these things. I think I would wade into a debate about calibrating sanctions where I have no expertise.
George Moody.
Mr. Tucker, can we accept the central fact that the LIBOR system is hugely important to large parts of the financial system?
Yes.
And hugely important to the credibility of London?
Yes.
Now,
not only to London, but to more broadly.
But as it's set here,
yes,
if anything goes wrong, it reflects on us. Now, what you've been asked several times, and you've given a wee bit of an answer there and a bit of an answer there, but what part does the Bank of England accept, or does it accept any responsibility for the integrity of the LIBOR system?
We didn't see ourselves as having that role, Mr. Moody. In 1997-98, we stopped being a regulatory body.
Right, but then just rethink what we're saying. You think it's totally crucial to the credibility of London as a financial centre, and you think it is hugely important to the financial system, and you're the Bank of England. Now, don't you think you may not have the legal responsibility? It's a BBA responsibility. You're not the regulator, as you've said.
Yeah.
But don't you think that it would be very, very important that that system worked and worked honestly?
I do think it's important.
And I could accept...
And I see the tension.
Yeah, I can accept, you see. I genuinely can accept, but I think that's why Mr. Diamond threw it in. But maybe he didn't throw it in, it was in the reports. But Mr. Diamond's organisation was stealing from customers from 205 to 207. It was clear crookedness. They were rigging the rate for the personal benefit of themselves as bonuses and the firm's profits, right? He throws this in because it's very important, because the excuse is it's a different situation. There is a financial crisis that we haven't seen for decades, and this might be a minor matter compared to, and probably if you asked us to list the priorities, sorting a financial crisis out would be the top. But if a thing has integrity, it has an integrity in it has to keep its integrity solid. We can't have a bit of integrity in good times, but never mind, we're going through troubled times. You accept that?
Yes.
You're saying then, but that brings me... Sorry.
I'm sorry.
So no, go on, Mr. Tucker.
And had we thought we were being, had I thought that I was being alerted to dishonesty, I would have passed it on to the FSA, and we were during the spring. We were really concerned about the erosion of credibility of the LIBOR process.
You see, I think that's, we've progressed there, but what I find difficult is what happened afterwards, because you referred to this review, but I mean, and even the answer that's given by John Ewan, when these several group members made this allegation,
Yes.
John Ewan, in the minutes, outlined the quality control and safeguard measures used by the BBA.
Yes.
And that seems to have been accepted. It's naive, the Bank of England, the FSA, to sit there and hear serious people make allegations, and the fellow who runs the system says, oh, we've got these quality controls. You'd expect a regulator, and you expect the Bank of England on such a matter to say, well, we hear it, but we better have a look.
And I think by the spring, when there were more widespread questions of the credibility of the process, not its honesty, but its credibility, I think then we were engaging with the BBA, I think in a pretty powerful behind-the-scenes way, but not in December, although I would note...
Yeah. You see, the trouble is, Mr. Tucker, it's what happens. You see, they go off to do a review, and the evidence from the American regulators is that in August they published its findings from the review and concluded from the contributing panel banks' comments, including Barclays, that the contributing banks were confident that their submissions reflected the cost of borrowing in the London interbank money, and that the existing process for LIBOR submissions was appropriate and should be retained without modification.
And the preliminary document,
no, that was the document that went out, and that was after consultations. Because I've got your...
But during consultation...
Yes, it went out, and then it came back, and then they put something out. And let me just read the final thing that makes me worry about the Bank of England. Might as well get on. The final section of the draft notes that they wrote to the Bank of England, they said, oh no, let's have your consideration. They discussed it with you on Monday. The final notes that this is the change you made. The Money Market Committee have extended an invitation to relevant public bodies and central banks to observe the processes. The Bank of England wrote back, we are concerned that that may imply that the public authorities will play some role in ensuring the integrity of the process. So may I suggest an alternative formulation as follows. The committee have extended an invitation to relevant public bodies and central banks to maintain dialogue on LIBOR in relevant markets. Now, first of all, it's not picked up, but even when they do the review, and they even suggest you might sit in on it or do something to watch it, you say, well, we'll have a dialogue.
And the New York Fed took the same view as we did during that period.
Yeah.
And what I would say is, and it turns out this may have been incorrect, the BBA consultative process went well beyond banks to users. I pushed, they may have done it anyway, but I made clear to the BBA that I thought they needed to do that. When they put out their consultative paper, I am not aware of comment going back to the BBA from any quarter saying you've got this wrong. There is a problem.
Okay.
There was plainly a disparity between dollar LIBOR in London and dollar rates in the States.
Okay. No, sorry.
And that prompted this whole review by the BBA, on which they consulted, and we didn't hear or find or
let me just ask you
it had been undermined.
Let me just ask you this, Mr. Tucker. When did you first hear that the American authorities and the FSA were in looking at LIBOR with very serious questions?
I can't remember exactly.
No, which year? It wasn't this year.
No, 2000 and...
Well, the question I ask you as a politician to the Bank of England is this. This is getting to be a pattern. When I sat on this committee with Northern Rock and asked the Governor why he hadn't intervened, not my responsibility. Yes. FSA, I had no powers. Bob Diamond, Mr. Diamond, I won't get as familiar as he is, but Mr. Diamond, why didn't you I didn't know. I was only the chief executive. I didn't know anything about this. You've said today, you opened up where I was the markets director of the Bank of England. It was my job to know what was going on. Well, there was crookedness going on, there was market manipulation over 2 years going on, and you were told on 2 separate occasions, right.
I don't accept.
But the big question, no, well, we can argue and you can put your case, but the big question is, if I were running a place and I watch other colleagues in councils, in hospitals, etc., they realise there's something wrong and the supervisors or regulators are in. First thing they do is get stuck in to clearing out the stables so that when the report comes out, they have their hands up. What have the Bank of England done? If they had taken action to properly regulate, to put proper controls in, when this broke, they could have said it was, as you said, we've heard your excuses, perfectly a livable way, but we've sorted it out.
There is another BBA review going on of the design of LIBOR, and we have fed into that over some time that we would prefer to move to a transaction-based system. And that we're not in a position to order them to do it.
An eyebrow lifted. Not
an eyebrow lifted.
Was it 2?
That we would prefer them to move to a transaction-based system, and that the massive transitional issues that presents need to be thought through. We did not realise that every shred of its credibility was going to be torn up.
What confidence have you got that LIBOR's working normally now?
Well, actually, big picture terms, giving reasonable indications of funding cost, and which banks are more under pressure and which not reasonable, yes, in the way that I described during 2008.
With no rigging of markets?
In 2000...
Confident that there's no rigging of markets?
You can't be confident of anything after learning about this cesspit.
What action's been going on recently to make sure that it isn't
Well, the regulators have an inquiry going on, and there is a review of the construction of LIBOR going on.
You're a non-executive director of the FSA, aren't you? And you have been since the spring of 2009. Did you step aside at all from FSA board meetings while this was being discussed?
There wasn't, not entirely. There haven't been discussions of this inquiry
at board level in the FSA?
Detail with me there.
None at all? Has this been discussed at board level by the FSA?
What has been flagged at board level and discussed amongst the authorities is that what would the contingency plan be if LIBOR collapsed as a piece of...
Okay, but I'm talking about the investigation. Was that being discussed at board level?
Other than in very high level reports, no. Not that I know of.
So you haven't been involved in any of this investigation?
No, absolutely not.
Did they come and see you and interview you about it?
I made clear that I was asked on a voluntary basis to see the 3 bodies doing the investigation, and I saw them.
And who interviewed you about the discussion you had with Mr. Diamond?
The discussion was led by the American authorities.
Andrew Ledson has a question.
Yeah, it just seems to me odd that, a bit like in the inquiry with Bob Diamond, he seems to sort of say nothing ever came to his desk, and yet there were clearly procedures that should have been in place and weren't. And it just concerns me that you seem to be saying the same thing, that you have procedures, but you're all far too busy to follow them. And arguably, don't you think that it's precisely when there is a crisis that if you have procedures to write down a note of every contact you have with a bank, that a crisis time is the time to do it? And there are something like 1,000 employees at the Bank of England, or is it not?
2,000.
2,000, okay. So it just seems odd that all of this is going on somewhere down in the bushes there, and yet the people who should actually, between them, be doing something about it are all saying, oh, well, I had no idea, I wasn't aware, no one brought it to my attention, it's nothing to do with me.
The extra pressures are not just on the senior people. We had to scale up our collateral team, I don't know, probably by an order of magnitude because of the amount of lending that we were doing. I mean, every team at every level was under absolutely extraordinary pressure. As I hope I conveyed earlier, we accept that we need to go back and think about this. How easy it will be to address this while the crisis is continuing, I don't know, but we need to draw the lessons.
Well, I need to move on. Andy Love.
If it hadn't been for the persistence of the American authorities in this matter, these reports might never have come out. What does that tell us about the regulatory structures in the United Kingdom, and with all the changes we're making, will they be enough for us to be able to say we deal with the problems that occur in our market?
I think we should all be very pleased that we're moving to a Twin Peaks system where there is a separation between market regulation, the regulation of conduct in both wholesale markets and retail markets on the one hand, the FCA, and the oversight supervision for safety and soundness.
But it was persistence that led the American authorities to continue with an inquiry when the FSA stopped.
And I think, I'm sorry, Mr. Love, I think you're more likely to get that persistence in, I'm a really strong believer in Twin Peaks, in a regulatory body whose sole purpose, core purpose, is conduct, regulation, wholesale and retail. It is often said over the last couple of years that the FCA will be the poor relation in all of this split that's going on. I've never believed that for 1 second. I think that my personal view is that probably a quarter of a century too late, London is going to get a proper securities and market regulator for the first time.
Right, this is a very specific hearing on a specific point, and
this is very,
John Mann has one very quick.
This is very specific on the contingencies that you've been planning, because unlike British local authorities,
I'm assured, by the way, that this is a quick question.
Unlike British local authorities, who were barred in 1997 from buying these complex products, American local government has been doing so hugely, and that's the basis of the lawsuits, with large numbers of local states suing. I mean, what contingency arrangements are in place, and does this have a macro impact because of the impact on British banks?
So there are two elements to the contingency planning, which is beginning, particularly the second bit I'm going to mention. One is, what happens if people just won't participate in LIBOR? How do all of these contracts get priced the following days? And then secondly, which I think is the point that you're referring to, could the class action suits, or whatever they're called, cause such financial damage to the firms that it could undermine stability? And people are starting to think about that too, not conclusively yet, but that is people are focused on that.
Mr. Tucker, you've told us that at various times it was well known or well understood, including by you and the bank, that Barclays were the next in line, or they were certainly under pressure at this time of intense stress in the markets. And you've been saying that you encouraged Bob Diamond to take a special notice of what was going on in his Treasury department. Indeed, that's the central response to the interpretation of the email. Were you therefore surprised, as frankly many of us were, that he didn't notice that his bank was manipulating LIBOR submissions?
I really don't know. I know very little.
Wouldn't it be a bit surprising?
What I'm surprised by is that the compliance people and the supervisors on the dealing floors didn't identify this and elevate it upwards. I haven't heard a suggestion, and this may be wrong, that people did elevate it and it didn't reach him.
Okay. This is a hearing called at very short notice, largely at your request, and we're particularly grateful.
For which, thank you.
To you for coming along and being frank with us this afternoon. We've learned something for our inquiries, and we're very grateful.
Thank you very much.
Portcullis House, line 4, the Wilson Room. Portcullis House, line 4, the Wilson Room. Portcullis House, line 4, the Wilson Room. Portcullis House, line